Okay, we're back. We're going to talk about revenue versus capital expenditures. You've got long-term assets on your balance sheet. Occasionally, during the ownership of those assets, you decide to spend some money on them. The question that's posed to us here in these slides is the amount of money you spent on them is going to cause you to have a debit into your accounting system somewhere. You're going to credit cash, you're going to debit something. And that's the whole question being asked here. What do we debit when we spend money on our property, plant, and equipment assets? What do we do? Were we just maintaining them for the current year, something we're going to have to repeat next year, like change the oil in our truck? That kind of an expenditure would be called a revenue expenditure. Or are we rebuilding the engine of the truck? It's going to last longer. That's not a revenue expenditure. That is a capital expenditure. And so we have to make the distinction. What kind of distinction are we trying to make now? Where does the debit go? Does it go to the balance sheet, making the asset more valuable, or does it go to the income statement as an expense? And we'll walk through these ideas. So these questions here: does the expenditure extend the useful life of the asset? Does the benefit of the expenditure extend beyond the current fiscal period? Those are important questions. If the benefit doesn't extend beyond the fiscal period, like change the oil in the truck, why doesn't it extend the benefit? Because you have to do it again next year. I've had students logically say to me, when I say that, change the oil in the truck, they say, well, if you don't change the oil in the truck, it's not going to run next year. So it does give you a benefit next year. Well, yeah, it does theoretically, but in an accounting sense, what we're worried about is, do I have to spend this again next year? Yes, you do when you change the oil. You got to change it on a regular basis. So the expenditures to maintain your equipment, lubricate it, tune it up, change the oil, that kind of thing, minor repairs, tighten a bolt, fix something, those are going to be repeated next year, so they don't give you a future benefit. Therefore, the debit for this expenditure is going to sail over to the income statement as an expense, and we call it a revenue expenditure. The expenditure was made to enable us to continue to earn revenue during the fiscal period. However, if we make a typically big investment, an expenditure that does materially change the asset, the debit is not going to go over to the income statement because it gives it some benefit next year and the year after and the year after, like put a rebuild engine into the truck. That certainly should be, under normal usage, a benefit in future periods beyond the current one. So, ordinary maintenance and repairs then go to the income statement. The debit will go to the income statement. However, extraordinary repairs, those are repairs in the accounting use of the word extraordinary that extend the life of the asset. And a classic example is put in a rebuild engine. The truck it's a Peterbilt tractor, diesel, with you put a new turbo Cummins engine in it after it had 200,000 miles on it, because of problems you had with the engine. Well, your depreciation schedule is not valid anymore. That truck is going to run longer than you had it originally scheduled for. If it only had 2 years left on its schedule, you put a rebuild engine in it, extremely expensive. I mean, these cost tens of thousands of dollars. It's going to run longer than you originally scheduled. That would be called an extraordinary repair. The debit is going to go over to the cost account for the asset. The recorded historic cost is going to get bigger with that debit. A little refinement of that idea would be a betterment in the way of a large expenditure where the debit does not go to the income statement. We call those in accounting betterments. And an example might be, we have a fleet of trucks, long-haul trucks. We decided in each truck to install global positioning tracking system and a recording system that allows us to know, Central Dispatch can look on a computer screen and see where all their trucks are across the country at any one time, because they have GPS telling them where they are. They can download mileage data from them. How many hours were you driving? How fast were you driving? How long did you rest? Did you comply with ICC regulations for all those issues? So the betterment is, it certainly makes the asset more efficient. The dispatcher can have way better control over getting the trucks through their schedule and back where they're supposed to be using that software and that information stream. It costs probably a considerable amount of money to put into each truck, but it won't make the truck run any longer. The truck won't go more miles because of this betterment. So classically, electronic controls, automated controls on machines, those kind of things are expensive and costly. They are capital expenditures, but you got to depreciate them over the remaining useful life of the asset. The useful life won't get bigger because it doesn't let the machine run any longer. It just runs more efficiently. Those are called betterments. And so we need to keep those ideas in mind. The questions we have in this regard are pretty basic. They're not very complicated as we move on. So here's a journal entry for an ordinary repair. What are you looking at? The debit. Where did that debit go here for this ordinary repair, truck repair, or lubrication, change oil, whatever? The debit went over there to the income statement. Truck maintenance expense, truck expense, vehicle expense, whatever you want to call it. Betterment. What did we do here? It doesn't say what we did, but it was a $2,000 expenditure, and it was decided it was a betterment. It's not going to make the truck run longer, but more efficiently, so we debit the asset account, the truck itself, the equipment for the truck itself. Well, now our depreciation schedule's got to be revised, because you got to get rid of that value over the remaining life of the asset. So you revise your depreciation schedule. And we have a credit to cash or accounts payable in this case. Here's an extraordinary repair. We're rebuilding the truck engine here. So that's going to make that truck run longer. So we're going to revise our depreciation schedule to get rid of this value over time, this $3,500, but you're going to have more years to do it or more miles to do it, depending on what you're using, than you had originally scheduled, because it'll make it run longer. That is an extraordinary repair, a capital expenditure. So we won't go, I don't want to go through those examples, but back to this picture, I think it's a reasonable way to view these things. And here's the question I pose that you're asking in these cases. You spend money on the asset. Does the debit go to the income statement? Then it's an ordinary repair. It's a cost of the time period. If the debit goes to the balance sheet, it's because it made the asset more valuable, because it's more efficient, or it's going to last longer. In other words, the benefit from that expenditure extends beyond the current fiscal period. That makes it a capital expenditure. That makes you debit the asset account for the expenditure. So these are important. Let's go take a look at an example of that. It's Quick Study 7. Let me pull that up here. The reason I want to assure you what to expect here. This would be classic as to the questions you might see on the test regarding these. So look these over. There are 4 things that happen, and you just are trying to answer the question: revenue or capital expenditure. How do you decide? Ask yourself, will the benefit extend beyond the current fiscal period, or do I have to do this all over again next year? I'll pause for a minute.